Birkenstock gearing up for its initial public offering this week. The company will be the latest addition to the list of high-profile public listings. That, of course, includes Arm and Instacart. But with a wobbly IPO market, investors may want to think twice before jumping into the new stocks coming to Wall Street. Joining us now is Torch Capital founder and managing partner Jonathan Caden. So, Jonathan, let me start there. We've had this trickle of IPOs, Jonathan. Arm, Instacart, Klaviyo, maybe Birkenstock, ready to test the waters. I'm interested, what do you make so far of the reception these names have gotten from the public market investors, Jonathan, and what does that response tell you, if anything?
Hey, Josh, great to be here. It's rocky. We are not in the clear. People thought the IPO market would be opening. This is the beginning. I think it's going to continue to be very uneven. Klaviyo and Arm went up, but they're back to around their IPO price, and Instacart's, I think, trading at about 15%. So it's still a lot of uncertainty and definitely not an open market. And at Torch, we've been advising our companies to probably hold back till next year at the earliest until we see what's happening. I mean, I still think stocks are overvalued. They haven't been, discount rates are higher, and there's still probably rate hikes ahead than the stock prices have priced in. So we're still very cautious and think it's going to be uneven for a while.
John, this is so interesting because obviously you've invested in a lot of companies on the private side that you think are worth it, investable at the valuations that you're offered. But I'm curious, if I'm a public market investor and I'm interested in these IPOs, like what kind of criteria should I be using? How do I know if Birkenstock is worth buying, for example?
Well, I think you also, to start, should look at comparisons, right? That would make it bigger, the third biggest footwear brand right behind Nike and Deckers. So bigger than Crocs and Steve Madden and Skechers and a ton of other huge companies. It was also valued at $5 billion in 21. So that's one thing, just where you think it falls on that line. The second thing is, how are consumers feeling? What do we think consumer behavior is going to go? At Torch, we look a lot at consumer behavior, not just where it is right now, but where it's going. And I think in the long term, it will be a very valuable company. It's very much in style, ingrained, long history, authentic brand. But it looks like consumer spend is going to be challenged as well. There's been talks of recession for 2 years now. It hasn't happened, but it doesn't mean it won't happen. And when you think about what's a must-have, a need-to-have item versus a nice-to-have, Birkenstock falls in a nice-to-have. And if people are tightening their belts, that may be the type of purchase that they may not make at the the next year or two.
John, how many pairs do you have?
I actually don't have any, but I did a long time ago.
Fair enough. We were discussing that recently amongst our team and how they've had a resurgence. But Josh,
I've got two, Jonathan.
Yeah,
I can loan you a pair if you want. I don't know if you want them if you're interested, but the offer's out there.
You see them out all over the place. It's amazing, when you think about the style trend of high and low, sort of something very fancy with something sort of more basic. They've nailed that, and you see people out in New York City at very nice restaurants and clubs, and they're still rocking a Birkenstock with a fancy dress or a very nice outfit. So they have done incredibly well as a brand and positioning as a style company. It's just, where does that fall in the bigger macro equation?
Yeah, you can't take them out to dinner, Jonathan. You wouldn't take my pair out to dinner, but I take your point. But let me ask you this,
Not
Jonathan.
mine or
Another
not yours. Maybe Julie's.
Right. Another interesting dynamic I want to get your take on, Jonathan, is just the backdrop here is that for the first time in a long time, investors do have alternatives. You can duck into T-bills or boring old money market funds yielding 5%. Does that change the kind of company, Jonathan, you think can go public right now and win over public market investors?
Yeah, absolutely. I mean, I think there's a risk-reward equation that investors have to continuously be making. I do think if you're too safe, you're going to miss out on a lot of opportunity, but there's real risks in this environment. And so, like I said, Torch has told our companies to hold back on IPOs, and you really have to be very clear-eyed on what the real growth potential is based on the price that it's going out at. For where Torch normally invests, yeah, exactly. We're looking across the consumer ecosystem, companies like Acorns we backed, and Roman or Ro Health, a telemedicine company, or Ro Banking, or DigitalOcean, which had a very successful IPO a couple years ago. We're really focused on the early stage, and I think there's tons of value there. Valuations are down. Capital is much harder to raise. We're seeing much higher quality founders. They're raising with less capital, so they're forced to be more focused. And as we've seen historically, the most resilient companies are built in the most turbulent times. And so we're investing of where is the market going to be in 3, 5, 10 years. And early, we're getting in at a low enough point that I think early stage venture continues to be a great asset class. And I think 2024 vintage is going to be probably one of the most successful vintages in recent memory.
That's really interesting, John. And then on the flip side, when they are ready to come public, like what is the sign for the all clear that you would be looking for going into next year? Is it a crop of other decent IPOs, or is it more sort of general market conditions?
I think it's three things. Definitely general market conditions. You can't swim upstream. I think it's some successful IPOs that sort of correlate to your sector. So the recent comps that reset where pricing is and give people confidence. And the third thing is, you never heard this the last 3 years. I mean, we witnessed one of the biggest bubbles in venture and tech history. But how profitable are they? What is their actual potential cash flow positivity? Discussions that weren't being had 2 years ago as all these SPACs and IPOs came to market, and they got punished for it. So it comes back down to fundamentals. You have to believe in a big growth story, but then you have to have that somewhat proven out and a clear line path to where that goes, much clearer than it was required 2 or 3 years ago. And so really all three of those come together to make, I believe, a successful IPO.
All right, Jonathan Keaton, that was great. Appreciate it. Thank you, sir.
Yeah, pleasure to be here.